In the last briefing, I warned you the silver market was about to turn violent. Not volatile the way finance media uses the word to sell headlines, but volatile the way a controlled demolition looks right before the first column gives out. And then it happened on schedule. Silver ripped to 117.40, the kind of intraday print that makes every late buyer feel like a genius for about 20 minutes, and then, like a trapdoor, someone yanked the floor. By the next session, the screen was flashing $103, a 12% crash in roughly a day, billions in paper value erased, and a familiar question spreading across every trading desk and comment section: was that the top, or was that a setup? Because here's what separates amateurs from survivors. The amateurs watch price. The survivors watch motive. They ask why the move happened when it did, why the justification arrived when it did, and who benefited from the timing. So let me ask you directly. When it hit $103, did you panic? Did you sell because a headline told you the story was over? Or did you hold because you sensed what this really was? The biggest bear trap silver has staged in modern history. Within hours, the mainstream narrative snapped into place. Neat and convenient, like it had been prepared in advance. Reuters, Bloomberg, the usual pipeline ran the same basic line: a labor pact in Chile, roads cleared, supply restored, therefore silver crashes. It sounds clean. It sounds rational. It sounds like the market processed new information. Except the story collapses the moment you look at what they quietly omitted and what they assumed you wouldn't bother to verify. Start with the timeline. Finning releases a statement on January 25th claiming an agreement was reached. But what they don't tell you is the agreement isn't ratified. There's no union vote, no final sign-off. It's tentative, in principle, the kind of language that means nothing until the workers themselves approve it. And if you've watched Chilean labor disputes for even one season, you already know how this works. Tentative can become rejected in a weekend. In principle can become extended stoppage for weeks. Announcing an agreement without ratification isn't resolution, it's narrative. And the timing matters, because they drop it on a Saturday night when markets are closed and liquidity is thin, which is exactly when you plant a story that will be weaponized the moment futures reopen. Now the second problem, even the roads are clear angle is shaky. As of Friday, January 24th, police had cleared protesters, and then demonstrators returned Saturday morning and reestablished the blockade, meaning the system that supposedly unblocked supply had been obstructed through almost the entire trading week leading into the announcement. When a headline tells you everything is resolved, but the physical reality was blocked for 95% of that window, you're not looking at a supply story, you're looking at cover. And then we get to the detail that should make you laugh until you realize how many people traded on it. Finning isn't the mine. Finning is a machinery and equipment contractor. The striking group represents contractors, service providers, not the miners extracting ore. Even if an agreement is ratified tomorrow, you're talking about logistics support, not a sudden flood of newly produced metal hitting the market. And here's the final punchline. Escondida is a copper mine. A giant one, yes. Over 1 million tons per year, a meaningful slice of global copper supply. But the narrative glued to silver prices is still absurd. You are being asked to believe a 12% move in silver was caused by a tentative, unratified contractor labor pact tied to a copper operation. That's not analysis. That's an alibi. So if that was the story they sold you, what was the story they didn't want you to see? The story of how the move actually unfolded, how the stop-loss hunt was executed, and why the physical market barely blinked while the paper market staged a collapse. That's where we go next. Watch the sequence like an investigator, not a spectator. Monday, January 26th, silver gaps up at the open as Asia digests the weekend messaging and momentum traders pile in. By mid-morning in New York, the breakout has become an algorithmic chase. It prints 117.40, clean, obvious, loud, exactly the kind of number that pulls in late retail buyers who swear they all dart right it to 150, while quietly placing stop losses at the most predictable levels on earth. Then, right when the market is stretched and crowded and emotionally overconfident, the headline drops. Noon. Prime time. Reuters puts the Chile labor pact storyline on the wire. And like a switch flips, selling begins. $150, 113, 110, 18. And then the cascade accelerates into the overnight session until the screen is screaming $103. That's not what organic selling looks like. Organic selling is messy, it's argumentative, it's two-sided. This was surgical. A controlled descent through known stop clusters, triggering forced liquidation at each rung of the ladder. And if you want the clearest footprint of forced liquidation, you don't look at the chart first, you look at the ETF plumbing. PSLV, the biggest paper-silver vehicle on the planet, traded 393 million shares on the crash day versus about 142 million on a normal rally day, a spike that doesn't whisper rational repricing. It screams stop-loss cascade. The market didn't discover a new truth about silver in that moment. It hunted for weak hands. It searched the order book for fear, found it sitting at the obvious levels, and pressed the button until the forced sellers were gone. Now pause right here, because this is the part where you decide whether you going to keep getting played by headlines. If you want more briefings like this, where we strip the narrative down to the mechanics, hit like and subscribe now. Not because it helps the algorithm in some abstract way, but because it puts you in the room for the next move before it happens. And drop a quick comment with where you're watching from, because I want to see how many people are awake for this intelligence briefing. Now, here's the part they can explain with a chilly headline. The physical market did not confirm the crash. Shanghai was trading silver at a premium to COMEX before the drop, and after the drop, that premium still held around $8 to $10. If physical supply was suddenly back, that premium should have collapsed fast. It didn't. Chinese buyers didn't flinch. India didn't flinch either. India, as physical premiums pushed to record territory around $8 over spot, even as the rupee weakened, which makes imports more expensive. That is the opposite of shortage resolved. That is hoarding behavior. That is buyers paying up even when their currency makes it painful. And then there's London. LBMA holdings down near multi-year lows around 200 million ounces in late January, far below what used to be considered a healthy baseline. Lease rates spiking near 8% when normal is a fraction of that, telling you bullion banks are paying up to borrow metal. Banks don't pay emergency rates when supply is flooding back. They pay emergency rates when they trying to meet obligations in a market that is tightening. So ask yourself what actually crashed. The paper price crashed. The story crashed. The physical signal didn't. Which means the next question is obvious. If this was a paper smash, who was positioned to benefit and who was engineered to lose? To understand who benefited, you have to separate paper tourists from physical accumulators. In a true liquidation of conviction, you would see the vehicles tied to real metal buckle, you'd see redemption pressure, you'd see the structures designed to demand delivery show stress. But that's not what happened. PSLV, the Sprott Physical Silver Trust, built around actual metal rather than pure paper exposure, held firm. Its ounces didn't hemorrhage. There was no wave of redemptions. While SLV showed a violent volume spike that smelled like panic and forced selling, PSLV looked like a vehicle being watched by buyers who understand the difference between price and availability. And that difference is everything. Because SLV is where momentum traders live, it's where fast money chases the breakout and bails when the chart breaks. Those traders are not trying to own silver in a world where delivery stress matters. They're trying to rent volatility. They set tight stops because they have to. They are designed to be harvested. And when the market drove through $115 and $110, $108, $105, it wasn't punishing long-term conviction. It was vacuuming up leveraged positioning. Now take it one level deeper. The commitment of traders data is the kind of document that doesn't ET trend on social media, but decides who wins the decade. As of the January survey window, U.S. banks, the bullion banks, flipped from massively net short earlier in the cycle to net long territory. That's not a small shift. That is a regime change. For most of modern silver history, banks being net short has been the baseline architecture of the market. When they flip, it means something structural has changed in their risk calculus. It means the players with the closest view of the plumbing no longer want to be trapped betting against the metal. And while banks were repositioning, managed money, the hedge funds and speculators, was cutting longs. That is what you would expect before a violent shakeout. The professionals who trade for performance will do risk into a rally if the tape feels like it was being engineered. Then the engineered crash arrives, and the late retail money, those who bought the top because the breakout confirmed, get stopped out at exactly the levels the algorithms hunted. This is why the $103 print matters. It wasn't random. It wasn't price discovery. It was placement. It filled the gap. It hit the technical retracement zone that desks watch. It pushed into an air pocket where volume was thin, maximizing the liquidation effect. And then, once the weak hands were forced out, the market rebounded, fast, because the underlying physical demand never left. The buyers that matter didn't stop bidding in Shanghai. India didn't suddenly get well supplied. London didn't suddenly refill. COMEX registered inventory didn't magically regenerate. Eligible metal didn't rush to become deliverable. In fact, the refusal to reclassify eligible silver into registered stock is one of the loudest signals in this entire story because it implies owners done at JT want to make their metal available to a system they no longer fully trust. And if you want one simple image to hold in your mind, it's this. Paper silver screamed crash, while physical silver whispered shortage. When those two messages conflict, the real market is the one where someone has to show up with metal. Now add the geopolitical layer, because this isn't just finance. Effective January 1st, 2026, China moves into a tighter export licensing regime for silver. China refines a massive share of global supply and consumes an enormous chunk of it, especially with solar scaling. When Shanghai trades persistently above Western benchmarks, it's not a curiosity, it's a compass. It tells you where metal is flowing. It tells you inventories are being pulled east. And once physical leaves Western vaults in size, it doesn't come back quickly, if it comes back at all. So if the crash was engineered and the physical backdrop never softened, the logical next step is to map the path forward. The trigger points the trap doors and the price levels that separate noise from the next leg of the move. Here's the uncomfortable truth about markets. Most people don't lose because they were wrong about the long-term trend. They lose because they get emotionally ejected by a short-term narrative at the exact moment the smart money is stepping in. That's what a bear trap is. It weaponizes your need for certainty. It floods the zone with a story that sounds believable, then uses that story to justify the exact technical move required to liquidate you. So let's talk about what to watch now, because if this really was a fake crash, if it was an engineered transfer of position, then the next act is not mysterious. It's mechanical. Watch COMEX registered inventory. Watch whether eligible metal continues to refuse reclassification. Watch lease rates. Watch Shanghai's premium. These are the gauges that tell you whether the system is stabilizing or cracking under stress. If the premium widens, it's physical tightening. If lease rates stay elevated, it's bank desperation. If registered inventory keeps bleeding, it's delivery pressure. And if those signals hold while the paper price tries to shake you again, you're watching the same movie, just a different scene. Now put yourself in the mind of the institutions who actually move size. They don't chase $117 into thin liquidity when everyone is euphoric. They wait for the forced sale. They wait for the stop clusters to trigger. They wait for the headlines to do their job. And then they accumulate where panic has done the work for them. In this story, that zone was roughly $102 to $108. That is, where the order book becomes a vacuum, where retail stops have already been harvested, where the chart looks broken to the untrained eye, and where the real buyers finally get to buy without chasing. And this is where you have to confront the most important question of the entire episode, the one nobody wants to answer, because it turns the market from entertainment into a moral test. If the paper market can be smashed with a narrative that doesn't change physical reality, then what are you actually trading when you buy silver on a screen? Are you trading the metal, or are you trading trust? Because if trust is the true underlying asset here, what happens to price discovery when trust breaks permanently? What happens when a delivery-based market becomes a confidence game, and the crowd realizes that settlement can mean cash instead of metal? I want you to put your answer in the comments, because your worldview determines your strategy. Do you think the system bends but holds, meaning this ends as just another violent shakeout within a functioning market? Or do you think we re-watching the early stages of a structural reset, where the physical market starts dictating terms and the paper market becomes a lagging reference, a suggestion rather than a price? And if you believe the reset is possible, ask yourself the deeper layer. Who gets protected when the system is stressed? The contract holders or the institutions that wrote the contracts? Now, back to the path toward $125, because this title isn't a fantasy if the mechanics line up. The market tried to break spirits at $103 and failed. It snapped back because physical demand didn't validate the sell-off. That means the next real battleground is the level that matters psychologically and technically. 110. If silver reclaims and holds 110, the move stops looking like a dead cat bounce and starts looking like a reloaded spring. Above $110, the targets stack quickly because the same algorithmic machinery that hunted stops on the way down will chase breakouts on the way up. The tape turns from selling pressure into short cover pressure, and that's when $115 and $120 stop being ceilings and start being waypoints. What would invalidate the near-term path? A clean break under $100 with follow-through and physical confirmation, premiums collapsing, lease rates calming, inventories stabilizing. But that's the point. The physical confirmation is not here, not yet. And if the physical market continues to disagree with the paper story, then every engineered dip becomes less effective over time, because weak hands are already gone. So the real question isn't whether volatility returns. It will. The real question is whether you can stop treating volatility like a verdict and start treating it like a tactic. Now we close the loop because this entire episode only makes sense when you see it as a three-objective operation. First, flush retail stop losses clustered at obvious levels, $115, $110, $108, and the psychological magnet at $100. Second, let bullion banks and institutional desks complete a repositioning cycle that the public rarely gets to witness in real time. The transition from net short posture to net long posture while price is doubling and headlines are screaming. Third, create an accumulation window at a 12% discount from the intraday high, right after the public was emotionally convinced the move was over. And once you frame it that way, the Chile Labor Pact story becomes what it always was: narrative cover. It didn't need to be perfect. It only needed to be plausible enough to flood the timeline, to give reporters a sentence they could repeat, to let commentators nod, and to give algorithms a headline timestamp that made the sell-off look rational. Meanwhile, the signals that actually matter, the physical premium structure, the inventory drawdowns, the elevated lease rates, the reluctance to make metal deliverable, kept telling the same story they have been telling. The shortage is structural, not cyclical. And structural shortages don't resolve because a headline says so. They resolve through one of two brutal mechanisms. Either inventories get liquidated until something breaks, or demand gets destroyed through price. The problem is that silver demand isn't a single faucet you can turn off. Industrial demand is embedded into supply chains. Solar demand has forward contracting and lag effects. New mine supply can't respond on a dime because most mined silver is a byproduct. And the timeline to bring new primary projects online is measured in years, not weeks. So when inventories are already thin, the path of least resistance in a panic isn't more supply. It's higher prices. That's why $125 is not a wild number in this context. It is a mechanical consequence if 110 is reclaimed and the market starts repricing risk around delivery and availability instead of narratives. And if gold remains elevated while the gold to silver ratio compresses, the math doesn't care about your feelings. The ratio is a pressure system. When it shifts, silver can move in bursts that look impossible until you remember what leverage and scarcity do when they meet a crowded trade. But don't confuse conviction with recklessness. This market will try to hurt you again. It will use another headline, another resolution, another supply coming back. Another perfectly timed story. The question is whether you'll recognize it for what it is. Because being right about silver and its long-term structure is meaningless if you keep getting shaken out at the exact points institutions are accumulating. So I want to end where we began, because it's the only question that matters after a bear trap like this. When it hit $103, what did you do? Did you panic? Did you sell? Or did you hold because you understood the difference between a paper smash and a physical signal? Drop your answer below and tell me what level you're watching next. 110, 115, or the full push toward 125ers. And if you are still here at the end of this briefing, you already know the real takeaway. The banks have shown their hand, the weak hands have been flushed, and the market just told you loudly this move is not finished.